Hey everybody, this is Charles Dobens, the multifamilyattorney.com, and I'm here today with Paul Moore. He flipped over 50 homes, 25 high-end waterfront lots, and appeared on HGTV's House Hunters. And he rehab managed dozens of rental properties, built a number of homes, developed a subdivision, and started 2 successful online real estate marketing firms. Okay, 3 successful real estate developments, including assisting with the development of a Hyatt hotel and a very successful multifamily project, convinced him of the power of commercial real estate. And he's the author of The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing. That was back in 2016. Paul also co-hosts a wealth building podcast called How to Lose Money. And is featured in guests on numerous real estate podcasts, contributed to Bigger Pockets and Fox Business. You said that there were at least 7 reasons why multifamily, in your opinion, is overheated right now. Now, Paul, you and I are very conservative. We understand, that neither one of us is going to overpay for property. We're not looking to get rich quick in this business whatsoever. But I may be a little bit more bullish on this market, multifamily market, than you are. And I love, first off, I can tell you, I could have this conversation for hours. This part of the business I absolutely love. So why don't you try to throw in a couple of your reasons why multifamily is overheated, and let me see if I can volley them back over the net and see if we can have this figure out who's right, Paul Moore or Charles Dobens when it comes.
Okay. Fantastic. Well, I think that the 7 reasons off the top of my head. Now, first of all, I just want to be clear. I still believe everything I wrote in my book called The Perfect Investment. In fact, I'm actually publishing it through an official publisher this year. Morgan James Publishing is picking it up because it's still selling pretty well. And so I still believe everything in there, but I do believe that a lot of people have jumped into this. I guess they all read my book. And so I just think it's overheated. So number 1, I believe that institutional investors are causing some problems for most of us. And here's why. They used to be, the REITs, the life insurance companies, the pension funds, they would be on the coasts, plus Chicago. They would be, in these San Francisco, LA, New York, Boston. But now they've moved into secondary and even tertiary cities. They're buying smaller assets. They're buying older assets. They're buying less stabilized assets. And they're buying in smaller geographic areas. You never would have expected a REIT in Lexington or Louisville, but now they're competing with us there. So that's number 1.
Okay, stop right there.
Yes, sir.
I don't disagree with you. And here's how I'm seeing it happen. I just went to Marcus and Millichap's regional conference here in Boston, and they were talking about the fact that over the next 4 years or so, they're expecting Class A property, the new construction in the primary markets, the vacancy is going to go from like 1.5% to 5%, because I think they are absolutely overbuilding the A-class properties. Mm-hmm. And at some point, you run out of A-class residents, and they don't have enough. Now, on the flip side, what was also talked about, and I'm actually, Paul, focusing now on building, but I'm looking at building workforce housing,
yes.
Which to the new developers and the new brokers, they call that C-class property. It's brand spanking new, so it's not. Yeah, but listen to this.
I can believe B.
I had the exact same reaction that you did. Like, wait a minute, that's not C-class. C-class is, chiller boiler systems, single pane windows, right. Flat roof, built in 1970. But in the new construction world, workforce housing is considered a C-class property. It's brand new, but it has no amenities. It's in a secondary or tertiary market, and that's what they consider to be a C-class property. So that, and according to Marcus and Millichap, over the next 5 years, the occupancy rate on those units is 98.5% or higher. And it's just unbelievable. So in that market, this is still a very strong buy. Hey, did you just lift your table?
I did, but I didn't want you to notice. I just noticed my head was like right near the top.
Hold on.
Well, look at you. Okay.
What do you shop at IKEA
For our
also?
listeners, hey. Okay. Anyway, Charles, it's amazing. I'm actually going to Chicago in 6 days to meet with a lady named Nancy Kapp. And Nancy is KAPP. She's actually building workforce housing in the, a multifamily in the fastest growing county in Oregon, which is, I think, where Bend, Oregon is. And she has the exact same argument. And we're actually very interested in investing with her because of what you just said. I completely agree.
Okay, so what I've done, and I'm right now in southern New Hampshire.
Mm-hmm.
I love New Hampshire, tax-free New Hampshire, living, bordering Massachusetts. The town I'm in right now, I'm 3 miles from Massachusetts. I looked at all of the housing, the workforce housing that's already performing between Nashua all the way to the seacoast in New Hampshire, about 9 communities. And as I was doing the research, you just go on apartments.com, you type in these towns, and you'll see that every single apartment building has a waiting list to get in.
Wow. Yep.
Yeah.
Same with Nancy's deals. She said every deal that they've done, and they've had to have a lot of discipline to keep their rents down because they could go up with a waiting list of 50 people. But she said they don't do it.
I'm telling you right now, when we're offline, I want to get a contact information because the biggest issue, had a couple conversations with commercial brokers and they're all telling you bad stuff. But the issue is the land. And
yes, that's right.
That's always, I'm sure that's going to continue to be the issue.
Right.
Where you go. So,
yeah.
All right, Paul. So you did not win on point number 1. Let's give you option for point number 2.
Okay, let's try number 2.
Okay,
hold
on. Let's see if Ohio State can beat Boston College. Come on, go ahead, Paul.
Okay, so our second I is international investors. I have a friend named Ben in Shanghai. He's from Dallas, and he moved to Shanghai, and he actually said that the investors he works with, very big money people in Shanghai, said that they would literally buy commercial real estate in the U.S. at a 0 cap rate because they want to get the exchange rate. How do we compete with a 0 cap rate? How do we compete with people who can break even on their cash flow just to get into US dollars, where they claim they think they can make about 40% profit by keeping their money out of Chinese currency? That's the second group we got personally beat out by at least one Chinese investor who had that mindset.
Okay, let me tell you once again why I am right, and you're just going to follow along with me here. Is because I tell you, I was evaluating a client's deal in California, and in California, to get a 1.2 debt coverage ratio on the deal, they got to put 50% down.
Yeah. Wow.
And you just think to yourself, well, you want to talk about an overheated market. That just doesn't make any sense whatsoever. But that's what they're doing. There's that foreign money that's coming in. Now, this ties back to what you were saying at the beginning about the institutional dollars going into the secondary and tertiary markets. They're being forced there by the foreign dollars. Right. So you're absolutely right. Okay, so that one you still haven't struck upon the one that I'm holding my hat on. But, But all right. Once again, that's excellent point. This is
number 3. Okay, so there's 2 I's and a 1. And that 1 is 1031 investors. 1031 investors, we had a guy come to us recently and he said, look, I can either overpay like by, let's say, 10% for the multifamily that my company's selling, or I can go pay, let's say, 22% in capital gains, whatever the amount was, I don't remember. But he said, I'd much rather overpay for the apartments than pay capital gains tax. So I think that is a factor as well. What do you think?
Okay, it's so funny you say that, because this morning, one of my students lost out a deal that she'd been working on to a guy who had 1031 money, and he definitely paid more than the asking price for the exact same reason that you just gave. So, but let me talk about the flip side of that. The benefit to that is, as an investor looking for funds, you got to hang out on those 1031 sites to find those people, because those guys are looking for deals. And if you can bring them a deal, then you might be able to partner with them, because they've got the money. They've got to put it to use within a certain period of time, or they're going to lose it.
Yeah.
And they'll be willing to work with you on that. So
Right.
yeah, that's a very good point. Very good point as to, okay, all right. So far it's a draw. Right now it's
Okay.
a draw.
Great.
Okay.
Okay, my next I is IRA money, and I concede in advance. This is a very minor one, but I think that there's more IRA, more self-directed solo 401k money than ever before. And for some reason, which I can't explain, Charles, it seems to me that people with IRA money are a little bit less careful in their investments, and they're willing to be a little looser and to say, well, it's only IRA money, I'll take a chance. And so I think they're overpaying a little bit. I don't think that's a huge point.
Yeah, I agree with you, and on both points, it's not a huge point, but it's probably true. I might be guilty of that myself. I just put some money in a friend's bank, and hey, I don't need it for 10 years. Like, hey, let's see how I do. And yeah, so that, okay. So okay, that was the lowest common denominator.
Yeah, sure. Okay. The next one is the Nuru Effect. And you say, what's a Nuru? Well, I think it's new gurus. These are people who weren't necessarily even investing in 2007 in real estate. And there's nothing wrong with that.
Or maybe they weren't even alive in 2007.
Or they were in junior high school.
Exactly.
But now they're gurus, and they're getting paid to train people to overpay. Is that impacting it, Charles?
I just found, folks, for those of you watching at home, I just made my new best friend. Paul Moore is my new best friend because he sees it the same way I do. Paul, you cannot believe how accurate that statement is. And let me give you some real life examples, okay?
Okay.
There is one guy out there, and I say, many people who listen to me know I say this all the time. There is one guy out there that says that you can overpay for multifamily property because the price never goes down. And that's the guy that's only 10 years old, because I can show you some of my properties that never came back in value back in 2007. So don't tell me that the properties don't come back in value. I'm a living proof. And this guy's out there. And all it's going to take, Paul, is for the market to turn and one investor not to get the money they thought they were going to get, and they go run into the SEC, and this guy goes down the toilet because the SEC would love to get this guy's pelt on their wall. And so to hear that, and I was at a mastermind group in Colorado, and I sat down with this guy, and he was a realtor from Charleston, South Carolina, and his family, he owns a big real estate agency. He's very, very successful. And he mentions the name of one of these Nurus. Okay. Mm-hmm. And I said, oh yeah, I know him. Actually, he was on my podcast, and I've interviewed him. And he said, yeah, and you could tell that the guy from South Carolina and I were doing that little dance, where one of us wanted to say something, but didn't know where the other person was. It's like, you don't want to run out and tell people you're a huge Trump supporter, but to find out that they're, with Planned Parenthood or something. You're kind of waiting for it. So ultimately, probably after another Manhattan, this guy comes along and says, I met with this guy, I had dinner with him, and I just he wanted me to invest with him. I looked at his what he does, and he's buying deals all the time. Yeah. And the deals, nobody's finding these deals. These numbers don't make any sense, but it doesn't matter. And here, my wife said it best. The guy is a transactional investor. Right. And that means that all he's after is the acquisition fee. Yeah. You know what I'm talking about.
Charles, I was at a conference in Miami in December of 2018, and I was really enjoying the conference, and all of a sudden some guy came on stage, and I thought, I recognize that guy. He wasn't on the agenda, and it was a very, very famous multifamily syndicator, and I was delighted. Well, He said, you know what, folks? He said, it's okay to overpay for multifamily. Just get in the game and get involved. You'll never regret it. And I literally, Charles, I literally thought there was going to be a punchline, like he was kidding, but he wasn't kidding. And actually that quote went all over the internet after that. And you know what? I've been reading Warren Buffett. I've been reading, a lot of these guys who are, Howard Marks, Ray Dalio. They completely and absolutely disagree with that attitude. Absolutely. And my money's with them.
Yeah, my money's I got Ray Dalio. Like my 401k investments are all based on Ray Dalio's.
There you go.
And same with the guy from Vanguard, his numbers.
Yeah.
Let me tell you, are we talking about the same guy?
Probably.
Yeah, I think we are. And, this guy was, like you started off this conversation, this point, this guy was not in the market back in 2007, 2008.
Yeah. I don't actually know that fact either way.
I don't
but I think you're right.
I suspect I'm right too. Wow, Moore.
Yeah.
Wow.
Yeah.
Wow. Hey, wait a minute. I just, you're not in relation to a guy named Kelly Moore, are you?
No, not at all.
All right, because he's a buddy of mine out here, and he went to Ohio State, and he's a huge Ohio State fan.
Oh, okay.
It's disgusting.
Tell him I said hi.
Okay, I will. I will. Okay, what's the next one after Nuru? What's after Nuru? Because we're banging through this, and I'm not in disagreement with you.
Yeah, I think the next one, Charles, is just the simple fact that the Jobs Act of 2012 combined with the world is flat idea of, brought on by the internet, allows way more people access to invest. And so now we've got investors investing as little as $5 or $10 or $20,000. We've got all kinds of accredited investors. The wealth levels are record levels, and millions of people who couldn't or didn't know about investing in commercial real estate are now able to invest. And I think just that supply and demand of money is the next sixth of the seven reasons I think we're at where we're at. That's what I think.
Yeah, I'm not so sure if that is as strong. I know why it's number 6 out of your 7. But I don't know. I mean, the people that you deal with are all accredited. They're all, making good money. But the issue that you're talking about there is secondary to the fact that there's so many of these investments that are just overpriced. And, because I always tell people, you can fix anything on a multifamily property. You can fix the roof, you can fix the foundation, you can fix anything. You just cannot fix overpaying for the property.
Right.
And that's it. So,
right.
All right, number 7, and I'm going to give you the one thing that you have not raised yet that I'm going to hang my hat on.
Okay, great. I just think it's a simple fact that cap rates often trail, or I should say that are a little, maybe 2 or 2.5 points higher than interest rates. And interest rates are hanging around this, more or less all-time low. So It makes sense that people would, not invest in T-bills, the risk-free amount, in the 1% range. Right. They might be willing to pay, let's say, 4.5% for a cap rate, when they before would have rather had a 4% T-bill than a 6% cap rate, if that made any sense. Anyway, you get the point. It's low interest rates.
It's that spread between the cap rate and the yield. Right. Okay. But that's pretty much the same as everything you said before about looking for investment dollars. Investment dollars chasing after some type of yield.
Yeah.
So, all right. So let me tell you how I look at it. And the thing, first off, this is not 2007's economy. This is a much different economy. I talk to people about my most favorite movie, The Big Short, and my most favorite scene in that movie is the stripper scene, where the stripper owns 5 homes. Well, today, a stripper is not going to own 5 homes. The financial underwriting for the mortgage industry has gotten so much tighter. It's not like it used to be. So we don't have I mean, we were going along, even when the market crashed, Paul, I never missed a mortgage payment. Everything was going fine. It was just the cap rates, the value of my properties. When the notes came due, I couldn't make up the difference because of the loss in value.
Right.
We are not at that stage. The stock market is doing great. And the stock market could go through a correction, but I honestly think the stock market going through a correction is entirely different than the commercial real estate market, the multifamily market, because it would not go through the same similar type of correction like it did back during the Fannie and Freddie period. And the reason is, Paul, is we are having more and more demand for our product. And our product, our apartment units, the demand for our product continues to rise like it never has before. And as a result, we don't have enough stock. We don't have enough supply to fit that. And so therefore, that's why the market's holding on to is that we can keep driving that interest, the rents higher, which is forcing the NOI. I mean, when you add in here the things like student loan debt. I mean, my kids are in their mid to late 20s, and they have no desire to own homes. It's just not. If anything, they will buy a vacation home somewhere before they buy a someplace to live, because their lifestyle is such that it just they just move around. And they don't want to be tied to it.